Mickey Dickey here, and I've got a couple of these reels seeing some of these idiots online who are giving some pretty bad advice. And I just wanted to throw a couple of these out there so you guys have a general idea what's going on out here and why what they're talking about just doesn't make any sense. Now, this is one of the videos, but I've got four of them up here. I'm just going to run through real quick and just give you some commentary on.
Million. Remember, they're giving you a loan, but it's a loan you never have to pay back. Because what did the insurance company promise? Life insurance? What's one of the promises life insurance makes?
If you die, we'll pay.
They're going to pay a death benefit when you die. The insurance companies don't say that you have to wait to die to borrow that money. So the insurance company, when they give you that million back, that loan for the million, it's in advance of your death benefit. Your million never leaves your account, never stops earning the interest. A lot of people don't understand compound interest. So if you put $1 million in and it makes 6%, now next year you're compounding on $1 million plus the 6% interest. And the year after, it's compounding again and again. So you're always compounding off a higher balance. But your money's
unless you
out
take
there.
it.
No, it doesn't matter. Remember I said, it doesn't matter if you take the money out. When you take the money out, let's just use $1 million for $1 million. $1 million in, take $1 million out. How much is left in the insurance policy?
Zero.
No, $1 million.
Then that's
so
the part
let me
I don't
explain
get.
that.
Why would an insurance company
So here's the
borrow
thing.
my million for 30 days and then let me take it back and still have the policy?
When the insurance company gives you the $1 million, remember they're giving you a loan, but it's a
Okay, so a couple of things. Now, he might not be giving you all the data here, and that's okay. But what I completely don't understand when they talk about this is that you're taking a loan. Now, let's forget about the fact that you can't overfund a life insurance policy, and there's a lot of rules and regulations with that, and I don't want to go into the nitty-gritty on this. What this guy is telling you is that you can get $1 million life insurance policy. You can borrow $1 million against the life insurance policy and never have to pay it back. He literally says that. But then he says that you're borrowing against your death benefit. So you may not have to pay it back, but somebody does because they're going to give it back. So again, if you have $1 million policy and you borrow $1 million against it, when you die, the life insurance is going to go to pay your loan back. So somebody does pay it back, but they're also going to pay it back with interest. So he's saying that it compounds in interest. But let's just assume for a minute that you're going to get 6% on your money. So you've got $1 million in cash and you invested into a life insurance policy. That's making you 6%. But then you're going to borrow your own money that you just put into the life insurance policy. Let's just say it's 6%. Why are you doing that? You're making 6%, but then you've borrowed your money back from them that you already had, and you're paying 6%. So you're netting nothing. And again, even if you could get 7% and borrow it back at 5%, again, why would you do this? It's your own $1 million. Why put it into something that you don't have access to? He's also not talking about the fact that if you get a life insurance policy, there's going to be an annual premium on it. So even if you put $1 million into it, they don't let you borrow the whole $1 million back. And again, I don't know what the face value is on it either. So again, he's not making any sense because it doesn't work the way that he does. Yes, it does have to be paid back by someone. Banks just don't give the money away for free. Life insurance companies don't give the money away for free. Makes absolutely no sense. Now this is another one. I love this gal. Now, listen to this closely.
Was never meant as a big retirement plan. A 401k was developed because after the Depression, people were not getting back into the stock market. So they created a 401k to make it easy for the average person to get into the stock market. You really got to do some research. Everybody, all of us need to really do our research when we're looking at just blindly accepting advice from somebody.
Yeah, blindly accepting advice from you.
So I don't think today you can save yourself to retirement. The interest rate's 2%, right? It was almost negative because it was zero something, and the fees you're paying brings you negative. So if you're saving money, are you trying to build as big a nest egg as possible to live off of? And who knows what's going to happen with inflation, deflation? There's so many factors. So I don't think saving and a 401k is a good financial retirement plan at all. I think it's probably...
The worst advice you can get is this person. I mean, seriously. It doesn't take a rocket scientist to figure this out. And again, I'm not going to go into a lot of the details on this and why 401ks started or didn't start. It's not relevant. But let's just do the math. If you have an employer who is giving you a match where you can put in $3,000 into your 401k and they're going to match it $3,000, that's 100% return on your money. Maybe I'm wrong, but it seems like a stupid thing not to do. Now, is it the only thing you should do? No, which again is why you put together financial plans to make sure that you can retire when you want to retire and how you want to retire. But not using a 401k that you have at your work is probably the dumbest advice that I've ever heard. And I don't even know most 401ks are only given a 2% return. Most 401ks have the possibility of at least putting money into an S&P 500, which has a return well in excess on an average of over 10% a year. Again, even if you just took the money and put it in a money market, and you got your money doubled because you took the money from your employer in the 401k, again, your return is significantly better. I don't know what this person's doing, but if you just shut her off, block her, don't listen to her because she doesn't know what the heck she's talking about.
For example, a 6% return on your IRA or 401k doesn't cover the current 6.5% inflation rate. Technically, we're all losing.
Okay, now, again, someone using short-term issues for long-term problems. The long-term inflation rate for the United States is 3.8%, period. The S&P 500 return, on average, is well over 10%. I'm really not seeing a problem here. That's at least a 6% return. Most people will even tell you it's an 11% return on the S&P, so you're talking 7. You should be doubling your money significantly better than that. But anyway, let's listen to more.
You know what? Let's just even say that inflation, we're back to normal. Still in your 60s, the average 401k and IRA balances for retirement, $209,000. Now you give that to a financial planner, they annuitize it with the maximum interest they can pay you. You're talking about $500 a month for the rest of your life, plus Social Security. Welcome to living below the poverty level.
Okay, now I'll agree with him there. That is an issue. Now I don't know what the average 401k balance for somebody that's over 60 years old is, and frankly, if somebody told me, I don't know that I'd agree, listen to him anyway. But this is a prime example of what to not let yourself get into for retirement. Get a financial advisor so that you don't only have $200,000 for your full retirement. But I'm telling you, if the average 62-year-old or 70-year-old or 65 or however old you are in retirement is $209,000, again, that's not a 401k problem. That's a you problem because you didn't invest enough, you didn't save enough over the course of your lifetime. And you didn't put together a financial plan with a financial advisor who walked you through what you needed to do. So don't blame the tools, blame the execution on your part. Now this guy, I don't even know where to start with this guy.
Well, it says here that you made $100,000 from your Airbnb last year. Yep, and the best part is I'm holding on to that hard-earned money, and I will be paying.
Now this one I'm going to stop and start a little bit because he's got a lot of moving parts, and I want to make sure you understand what's going on here. He's telling you that he's made $100,000 off of property. Okay, so keep that in mind for number one. And he's going to show you how he's not going to pay any tax on that $100,000. And this is the part I want you to keep an eye on because, wow.
Paying you anything. We're the IRS. We get money from everyone, including you. The thing is, not for me. See, I did a cost segregation study to bonus depreciate this property. So that's 80% of the income that I made last year that I don't have to pay.
Okay. And he's going quickly, so I'm going to try to break it down for you. He's saying that he's going to take an $80,000 deduction on this property off of the $100,000 that he made. Okay. Now, what he doesn't conveniently tell you is what he paid for this property and what his cost basis is. So he's just making up numbers. And if we're just going to make up numbers, what's the point? Are we talking about $1 million property? Are we talking about a $100,000 property? Are we talking about a $2 million property? Because if you take a normal amortization schedule or depreciation schedule for a property that's for $80,000, it'd be worth well over $2.1 million. $100,000 on a $2.1 million property, we got a bigger problem. But he's also telling you here in a minute some other stuff. So I want to go through the rest of this and just keep a listen to this.
Pay taxes. Okay, well, what about the other 20%? You still have to pay us on that. Yeah, I actually don't because I made $5,000 in interest payments last year on my mortgage and another $7,000 on insurance, property taxes, repairs, and a couple of trips to the property as well. There's $8,000 left, so yeah.
Okay, so now he paid $5,000 worth of interest. Now, I don't know what interest rate he's getting, and I'm not sure exactly what year this was, but let's just assume for a minute he's paying a 5% interest rate, just again, because he's just pulling numbers out of his behind anyway. So let's just pull them out of our own number. So if he only paid 5% and $5,000 in interest, he should only owe about $100,000 on the property, which begs the question, did he buy $1 million property and put $900,000 down so he has $100,000 mortgage, so he only pays $5,000? Plus, he paid taxes, insurance, repairs and maintenance of only $7,000 on the property. again, I don't know $1 million property that you could own and only have $7,000 worth of that. And I don't, again, unless you put $900,000 down on $1 million property. So I'm really having a hard time here because are we talking about a $100,000 property that you bought and you're renting it out for $100,000 a year and you're depreciating $80,000 on that property in the first year? Again, there's a multitude of problems with that scenario, but let's assume that's the scenario for a moment. If you started at $100,000 and you just depreciated 80 grand, you've only got 20 grand to depreciate for the next year. So you get to do this for 1 year. Well, there's a financial plan for you. So again, I'm having a hard time understanding how this is actually something that's repeatable and a process that can go on going forward. Because if you depreciate it all in the first 2 years, which again, is not really, again, I'm not a tax person, I'm not a CPA, so please understand. I'm just having a hard time understanding why anybody would listen to this idiot.
Have to pay us on that. Oh, and I donated $2,000 to my favorite charity, and the remaining $6,000 is in my Roth IRA that I maxed out.
Okay. Now, again, wow. Unless he has other income, you can't put money in a Roth IRA because rental income is not earned income. Sorry. But more importantly, it's a Roth IRA and it's not deductible off of your income anyway. I just don't understand it. And yes, maybe he put 2,000 to and maybe he segregates these out on his tax return. So this is one of his properties. I don't know. Maybe he has an income from another job. Again, he gives us way too little of information to be able to deal with this, but he makes it sound like he's just doing this and this is what everybody can do. And again, none of this makes any sense because none of it adds up. Because if you really start breaking down the individual parts of what he's talking about here, it just looks like he's pulling the numbers out of his behind. Which again, if we're going to just do that, then why don't we just, the federal government does it every day anyway, so what's the difference? But if you're going to listen to somebody, don't listen to this guy because none of this makes any sense. Roth IRAs are not tax deductible. And yes, you can do that depreciation schedule he talked about. But I tell you what, talk to anybody who's done it. And it's a pain in the butt because you've got to break down every one of those different items and have their own depreciation schedule and amortization schedule. And you got to do that every year. You can't just stop doing it. And again, once you've depreciated something, and if you're going to do an accelerated depreciation schedule, then you've got to deal with capital gains on the other end of it. So again, all I'm trying to point out here is these guys are not experts. And again, I'm not a CPA, so I'm not a tax expert anyway, but this stuff is just scary. So talk to a financial advisor, talk to somebody that actually knows what they're talking about when it comes to CPAs, and make sure you don't do some of this stuff these guys are talking about because you can get yourself in a world of hurt. Dickie out.